Hi and welcome to Swiss Codes Daily Market Talk. It's Wednesday, June 18th. Mounting Middle East tensions and rising bets of a possible US intervention boost appetite in oil, gas, and the US dollar. And it is in this tense geopolitical setup that the Fed is preparing to announce its latest monetary policy decision and also its economic projections and the dot plot. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So stocks sold off, oil and nat gas rallied while the US dollar gained as US Treasuries amassed safe haven inflows yesterday, along with gold as mounting geopolitical tensions between Israel and Iran and Donald Trump's early leaving of the G7 meeting spurred worries around the world that the US could eventually get involved in the Middle East tensions. So investors around the world are taking some risk off the table these days, bracing for further escalation of the tensions and a potential prolongation of the tensions with Iran. China, on the other hand, is getting tense as they're buying oil from Iran, and Russia is not happy to see a key and probably one of the last allies under such a rising threat. Israel, on the other hand, wants to finish with the nuclear threat of Iran, and the United States is warming up to the idea of a regime change in Iran. So that's the geopolitical setup of the moment. It's quite complex. The market's reaction is pretty in line with what you would expect it to be. The US crude jumped yesterday more than 5% and is consolidating near the $75 per barrel level. Nat gas added around 3.5% and is pushing toward the $4 per MMBTU. Inflows in gold remain limited over the past two sessions of trading as the US dollar amassed most of the safety inflows. The US dollar index, on the other hand, is again under pressure this morning in Asia as the euro dollar rebounds from 1.1475 mark while cable found buyers into the 134 level. The US 10-year yield, on the other hand, is near 4.40% this morning, down from above 4.60% by mid-May. So further escalation of the tensions will likely benefit to longer maturity US papers, help US dollar recover a part of trade related losses and support gold prices near their all-time high levels while continuing to support oil prices on expectation that Iran, if pressured, could block oil and gas flows near the Strait of Hormuz, where transits 20% of global oil and gas flows. On the other hand, Germany considers now creating gas reserves, a smaller version of the US strategic oil reserves to deal with this kind of situations, while tanker rates for ships carrying oil saw a significant surge in the recent days, unsurprisingly adding extra pressure on energy costs. And if that was not enough, two oil tankers collided in the Strait of Hormuz and three ships caught fire in the region, raising suspicions that Iran may be behind the latest incident, as it has been the case in 2019, but the exact cause remains quite unclear. What's clear, however, is that the region is boiling, and anyone betting against a rally in oil is probably crazy to do so. If trade through Strait of Hormuz becomes difficult, oil prices could eventually spike past the $100 per barrel level. Such a rally in oil prices would not be sustainable, of course, but would be enough to fuel global inflation worries and also bets for a cautious and hawkish stance from the global central banks as a response to rising inflation expectations. So it is in this tense and uncertain trade and geopolitical environment that the Fed officials are preparing to announce their latest monetary policy decision and an update to their famous dot plot later today. The Fed is not expected to make any changes to its rate policy at this week's meeting. The base case scenario is no rate cut today and two rate cuts from the Fed later this year. The first rate cut not seen before September meeting, according to the activity on Fed funds futures, because the probability of a September cut now stands around 63% before today's decision. Then economic projections and the dot plot from the Fed could tilt the balance toward one side, but given the rising uncertainties, on the geopolitical front that adds to the trade uncertainties. The Fed's growth and inflation projections could hardly be precise. So the indication that we will get from today's economic projections and the dot plot should be taken with a pinch of salt. I believe that the Federal Reserve will repeat that the monetary policy in the US is in a good place right now, and that they will be waiting for more data and more clarity on the trade and geopolitical fronts to decide what to do next. Data-wise, jobs data in the US remains surprisingly steady despite mass deportations, the Doge chaos, and the tariff uncertainties, while inflation rose slower than expected last month in the US despite an earlier jump in inflation expectations toward decade high levels. Now, looking at yesterday's data, yesterday's retail sales data from the US show that sales in the US fell for the second straight month, and the decline actually accelerated last month, while the US industrial production declined as well. Well, later data, the softness in that data may have fueled the expectation that the Fed could cut earlier than expected, but no, the Fed has no reason whatsoever to move when the visibility is so limited right now. So at best, the dot plots will point at 2 rate cuts in the last 4 months of this year. And at worst, the Federal Reserve members will cut their growth projections while raising their inflation expectations and ask investors to be patient before any such move. So if that's the case, the S&P 500 could top near the 6,000 psychological mark and enter a correction phase into the summer months, leaving investors with quite a heavy and uncertain geopolitical and trade negotiation agenda for the coming months. In the FX markets, the mounting geopolitical tensions could help the US dollar recover a part of its early losses this year, but the US dollar should remain under the pressure of worsening trade outlook in the medium to long run. And speaking of trade, Donald Trump, who left the G7 meeting in Canada way earlier than anyone imagined and expected, left some world leaders in quite a difficult position this week. While British PM could eventually get the US president to sign a trade agreement with some pending points about this still, but still he managed to make him sign something. Many other leaders didn't even have the opportunity to talk to him. In this context, Japanese Shiba failed to reach a trade agreement with the US, boosting recession bets for the Japanese economy. India didn't have the chance to push for a trade deal, while Australian PM saw his meeting with Donald Trump cancelled. Anyway, the British PM Keir Starmer's performance this week in Canada wasn't enough to prevent a drop in sterling yesterday, but inflation data freshly out this morning show that inflation in the UK slowed less than expected in May, fueling the hawkish Bank of England expectations for the coming monetary policy meetings. A lot, the accuracy of the British inflation data has been question lately, remember. Therefore, the Bank of England does should rapidly come back in charge of the market amid the worsening growth outlook for the UK economy due to some expensive fiscal measures and also somehow have resolved trade uncertainty with the US. For cable, the overall direction of the pair will obviously be mostly dependent on the US dollar's trajectory, but against the euro, well, sterling will likely continue to give back field. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.